Attention South Africans, if you thought that VAT was the only painful part of the budget speech 2025, think again. While there has been no official announcement about increases in personal income tax, there is a hidden tax that is going to cost you thousands every year without you even realizing it. And this is called bracket creep. And this is how government is going to take more of your hard-earned money without officially telling you. This taking is compounding year after year. Your salary might be going up, but so does your taxable, without you actually earning more. In this video, I'm going to break this down. I'm going to give you the latest on how the budget speech affects your personal income taxes. I'll be telling you about why you'll be paying more tax and essentially taking away any increase that you might have gotten with your salary. I'm going to tell you who's going to be the hardest hit with this invisible tax. And more importantly, I'm going to give you a strategy and a bunch of strategies on how you can find a workaround to keep more of your hard-earned money. If you are a South African salary earner, this video is for you. So make sure you share this video. Be sure to subscribe to this channel if it's the first time that you're watching. And if it is the first time that you're watching, hi, my name is Yolanda. I am a wealth advisor, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. I'm also the director of Solomon Wealth Management, where I sit with South Africans one-on-one here in South Africa, and also expat South Africans as well, where I help you plan for your wealth building in the South African context. So if you would love to chat to me one-on-one, click the link where you're watching this video and book a complimentary appointment. So let's try and break this down. What is bracket creep? Essentially what it is, it's taxes that slowly start taking more of your hard-earned money because government has not adjusted the various income tax brackets for inflation. This means that even if you've gotten an increase at work to keep up for your salary, to keep up with inflation, bracket creep takes away more of that increase, essentially leaving you with less money and also leaving you with less buying power. You might be even moving into a higher tax bracket because of this increase, meaning you pay more tax and you take less home. The bottom line is you might not be even getting wealthier, even though you might have had an increase in your salary. It's actually a very sneaky way of SARS collecting more tax without actually increasing taxes. So let's look at a live example of how bracket creep will cost you over time. Well, imagine you're earning 350,000 Rand a year in 2023. And 2023 was the last time that the personal income tax brackets were adjusted for inflation in South Africa. In 2024, the finance minister opted not to adjust it. So bracket creep crept in then. And in this year, 2025, he opted to do more of the same. So we find that compounding effect of bracket creep. And let's have a look at how that works. So if you are earning 350,000 Rand a year in 2023, you fall in the 26% tax bracket, meaning that you would pay around 56,000 Rand in taxes. All right. So if your take home is 350, this is your taxes. Everybody has to pay UIF. And that means your take home pay would be 291,369 rands per year. All right. And assuming that inflation is at 6%, you have a very generous employer and he gives you an increase or she gives you an increase to ensure that your salary is keeping up with inflation. So in 2024, your salary increases to 371 Rand. All right. Remember, 2024, there was no change in income tax brackets in South Africa. Now you jumped into a 31% tax bracket. Your tax now increases to 60,282, meaning your take home is about 308,592 Rand. 2025, your salary increases by 6% for inflation again. Now your earning, your gross is 393,260 Rands, right? Still in the 36% tax bracket. Remember, there's been no increase in wealth. You've just gotten inflationary increases to ensure your salary buying power is kept intact. You can pay your bills, right? You're not technically getting richer here. If you still fall into that 31% tax bracket, you're paying about 67,182 Rands in tax, making your take-home pay 323,951 Rands. Right, so you can see your taxes getting up every year, mainly because There's no inflationary tax break here. Essentially, those brackets should have adjusted for inflation, meaning when you get that extra pay to keep up with inflation at work, the tax brackets should have kept you in that 26% tax bracket, but it didn't. Right, so in 2023, on that 26% tax bracket, you paid 56 some change. 2024, you jumped to the next tax bracket. All right, 2024, you've got that inflationary increase. You jumped up to the next tax bracket. You paid about 60,282. Essentially, you paid an extra 3,787,000 Rand in taxes because there was no increase in this tax bracket. All right, there should have been an inflationary increase. 2025, Finance Minister announces that there is no adjustment for inflation on those tax brackets. Your boss gives you a raise 6% more. You're earning 393,260 rands, right? You kept in that 31% tax bracket when in 2023 it should have been adjusted, but it didn't. So you're in the higher tax bracket unnecessarily. You will pay in 2025 alone an extra 10,687,000 Rand worth of taxes. So in just over 3 years, you are paying 14,474 Rands more in tax by just earning more. So who is negatively impacted by bracket creep? Many as salaried earners, the working class, the middle class. These earners are most vulnerable because the salaried employee is getting inflationary increases, hopefully getting inflationary increases on their salary every year to ensure that that money is keeping up with inflation and you are able to maintain your lifestyle. You're not building wealth, just maintaining your lifestyle at this point. So when bracket creep happens, the first line that's attacked, it's the South African worker, salaried employees. Unlike high net worth individuals, people who get their income from capital gains, get their income from dividends, are not affected that much. It also impacts young professionals a lot because our young graduates coming to the economy, entry-level jobs, entry-level salary. And after a couple of years, there's significant jumps in salary because now you're more experienced. You've gotten more skill, you're adding more value to the business. You get a far more decent reflective pay of your qualification and experience. So when you get that significant jump in income, you're getting significant tax hits as well. So you are in the front line of this tax war. So without these inflationary budget increases, you're just losing more of your money to taxes. Very painful thing also are fixed income earners and pensioners. People that have their pension, remember when you go on pension, you're still paying income tax. And these inflationary tax adjustments not happening means you're drawing more to maintain your standard of living because why now? Utility bill is greater than the rate of inflation, so is medical aid. So now you've got to draw more of your pension to maintain your lifestyle. And when you draw more, you're earning more. When you're earning more, you're paying more taxes because of bracket creep. Well, the biggest gainers here, definitely SARS and the government. They collect more tax without actually doing the work because it's a copy-paste formula from 23, 24, now 2025. Right? They are collecting more taxes without technically making an announcement of a tax increase. Also, business owners and people that get their incomes outside of tax and rent and interest. Big gainers here because once you're getting dividend income, you are taxed at an effective 20% tax rate. Doesn't matter how much you earn, it's 20%. And also people that are getting income from capital gains, buying and selling property or businesses, that kind of thing, shares, unit trusts. Now those people are taxed at a capital gains rate, which is linked to your marginal tax rate, but is far more efficient than the personal income tax table. But how do you protect yourself? What can you do? Well, these are the strategies that I'm going to give you. And if you're watching a video like this, obviously you've somebody that's financially savvy, you want to learn more, you want to know how to do things differently. And I encourage you to go watch some of my other videos where we talk about this and we have a more narrower focus on the strategies that you can use. But also, if you want to work with me one-on-one and look at your income, how we can restructure it and how we can shield that, please click the link where you're watching the video and I'd love to chat with you. Now, the first thing that you need to consider is to reduce your income. But how do you do that? Because you need more money. because cost of everything is going up, and you also want to live kind of nice as well, right? So you can still get those inflationary increases, or if you're getting more than an inflationary increase, great. But you can still have that option in South Africa to lower your gross income, and you do that by contributing to a retirement annuity. Because remember that contributions to a retirement annuity is tax deductible. So if you earn R1,000,000, you have the capacity to invest 27.5% of that into an RA. Also, it can be a combination of pension and provident as well. But remember, it must be your portion, because the employer's portion is taxed as a fringe benefit. So in that RA, you can contribute 27.5%. If you do your full 27.5% of that million, is 275,000 rands. So essentially, you'll be taxed on 725,000 rand worth of income, as opposed to R1,000,000, essentially dropping your tax bracket, right? I mean, nobody earns a round figure. So you got to sit and do the calculations and see where you fit in the tax bracket. Another tool that you can use, and it won't be an immediate fix, but in the medium to long term, with a nice kind of strategy, it can really shield from what's happening, because this is a long-term thing. Government does not have a plan to grow the economy. They always talk about their spending and teaching and education and all of this, but they have no plan to grow the economy, mainly because of their socialist policies. Nobody wants to come and invest here. It's a very business unfriendly environment. The trade unions are grabbing business owners by the throat. It's just not working. So we're going to get more of this tax throttle from government, and you need to plan now. If you haven't been planning all this while, at least start now when you're watching this video. And the tool that you can use to do that is a tax-free investment. And it's not an immediate fix, because you're using after-tax money here. But essentially, you can contribute 36,000 as a year into this tax-free investment, and over time, build up something more substantial. With the right kind of strategy, you can be drawing tax-free income from this. All right? Important here to have the strategies. It's a big thing. The products without strategy can't give you the outcomes that you need. All right? You also, if you have the ability to structure your income from your employer a little bit differently. And I know that the rules in South Africa have changed a lot. A lot of the benefits, they're taxed as a fringe benefit. But where you can have leeway in having those negotiations, try and do that. So with the tax consultant and say, listen, my cost of company is so much. How can I approach my employer to restructure this a little bit differently? Also, diversify your income streams, right? Shift to investments. I know I'm sounding like a very salesy financial advisor here, but investments are very tax efficient. It's not immediate, especially if you're investing small amounts of money. It's a medium to long term thing. If you can get income outside of your salary, you'll be paying less taxes. Also, dividend paying investments are very lucrative. You're going to have, again, a strategy here. Dividend taxes in South Africa, it's a withholding tax. That means when you get paid a dividend from your shares at your unit trust, the 20% tax is levied by the broker, paid to SARS on your behalf. What you get in your hand is an after-tax amount, and it's a lower after-tax amount. And essentially, that's where you want to be. Okay, dividends in South Africa is tight because the business environment is tight. But outside South Africa, it's very nice. And if you need help with that, I can help you. So here are my final thoughts, okay? And hopefully you take it to heart. Tax bracket creep is a silent tax, and it affects all salaried individuals. If the government does not continue to adjust tax brackets for inflation, you are going to be paying more taxes because you're going to be earning more at work. And it's salaried workers that will face the full brunt of this tax war, because it is war. And it's a war that the South African government has launched on the average South African. So I hope you found this video useful. Please share it with your friends and family. Go and rewatch it, make some notes. And if you want to work with me one-on-one, you can book a complimentary appointment on my website, sonowinwealth.co.za, or click the link where you're watching this video. I'd love to chat with you one-on-one. Remember, the key to wealth is not just about making more money. It's about keeping more money and tax planning and getting income in various forms, different qualities of income help you get there. and I'm their wealth advisor that can help you achieve that.